I'm very excited to be joined by my three wonderful panelists who are all seed stage and early stage investors. This panel is called The Ins and Outs of Silicon Valley. And Topher, I want to put you in the hot seat first. SV Angel is one of the most iconic investors in Silicon Valley. The fund and Ron Conway have been called mentors to athletes, including Kevin Durant. So how exactly does SV Angel bridge the gap between entrepreneurs that need capital and athletes and other influencers?
Yeah, one of the things that we've always focused on at SV Angel is our network, is working with people across all industries, including celebrities, athletes, entertainment, media, you name it. We have very deep connections across a lot of different verticals. And so through that, we've got to know and work with a lot of athletes, including Kevin Durant, Joe Montana, who's also here, and help them get their feet wet in investing, in angel investing. And so, by doing that, we've been kind of built a reputation with, helping athletes and other celebrities understand what angel investing is and how to do it.
And Theresia, you have more than a decade of experience in investing. What advice would you give to someone who has brand and capital, but not necessarily the investing experience if they're trying to get into a seed stage and early stage?
Yeah, so what I would say is, use your networks, meaning get to know whether it's folks like Topher or Phin or myself, other people who, spend 24/7 in their day job doing investing. I'm sure that you have a ton of deal flow, but really you should leverage us to help do some of the legwork for you guys. We can help with deal screening, diligence, and really affiliate yourself with people who are spending all of their time doing their craft, which is investing in early stage startups. And so I think that that's a great way to leverage both your time and your dollars, and we can really be helpful with that piece of it. And then in addition, we can feather in sort of our deal flow, which is maybe coming from different sources.
Phin, what's your take on that? You were an entrepreneur for a while before you went into investing. Are there any secrets to being able to identify promising startups amid the thousands that you see every year?
Yeah, no, it's a good question. I think the biggest thing is knowing why you're investing. So what do you want to get out of it? I think the reality of most angel investments or early stage investments is you're not going to make a lot of money. It's, to any money. It's the big winners, the 1 out of 100 that actually emerges. And so you have to do a lot of it in order to be successful. And so figuring out what you want out of each investment. Are you investing because of personal interest in a space where you want to learn? Are you investing because you care about the mission of the company, if it's education or access to food, something like that? Or are you just investing purely to make money? And I think, and willing to be a little more passive. And so I think the way you evaluate companies has a lot to do with your motivations for making the investment in the first place, more so than some specific trick about how to identify a great startup, a great market, or a great entrepreneur.
Mm-hmm. And when SV Angel started out, there were only a handful of seed stage funds. Now there are tons of individual angel investors, seed stage funds. How do you differentiate yourself?
That's a good question. So for us, how we've differentiated ourselves over the last 10 years has been by helping founders, purely focusing on adding value to founders. And by doing that, by working hard, working diligently, and adding value, we've developed a great reputation. And so, for us, at the end of the day, the founders have kind of become our mouthpiece. When we help a founder solve a problem at a company like Apple or Google, they now tell when one of their employees or one of their friends starts a company, they now evangelize for us. And so that's been a great differentiator for us, has been our brand, has been our reputation. We developed that by really focusing on founders and adding value to companies.
And you decided for this newest fund not to raise from LPs and just to be individual angel investors. Why did you do that?
We did that because we saw a number of changes in the environment. What we saw was seed funds were getting a lot bigger. They were raising more capital from LPs, which meant that they had to write larger checks into seed rounds. There are also more funds than ever before. And one of the results of that is seed rounds, founders now were raising twice as much capital, and sometimes 3 times as much. And valuations had also risen quite a bit. And so we took a step back and thought, what is the best way for us to continue our mission, which is to really work with and help the best founders? And for us, that meant no longer raising outside capital. because we realized that we don't need to write a large check. We don't need to write a $200,000 to $300,000 check per company. We could invest our own capital and write a $25K to $100,000 check. And what that did for us also was open up the number of opportunities that we can see and also the number of funds that we can work with. Because we're not fighting for allocation anymore, now we've taken ourselves back and said, hey, for $25K, you get SV Angel's brand, reputation, network, value add, our team. And so, we decided to go the other way. And for us so far, it's only been a few months, but it's gone really well. We've made, I think, close to 15 investments, and working with, a lot of the funds and VCs that are here today.
We've been talking a lot about the changes in seed stage investing. And when you started Aspect, you said you wanted to bring elements of what it was like in the 1990s. So what did you mean by that?
So what I meant by that was really two things. One was getting back to focus. So being focused, laser focused on a stage, whereas Topher and Phin are very focused on sort of the seed stage. Being focused on the Series A stage, the stage right after that. We saw, like you mentioned, Selina, the huge number of increase in sort of seed and angel investors. And then I'd been in a fund that started out with that focus and had become sort of multi-stage all the way up to sort of, the billion-dollar pre-IPO rounds, as well as highly global. So Aspect is kind of, we call it back to the future, focused on Series A in the US and being, therefore, a better partner in a similar way to what Topher was saying, being the right size so that we could partner with seed funds and not have to write like the $10 and $20 million checks and crowd people out. The other part around that is really to bring back teamwork and collaboration. So my first 5 deals in 99, I'm dating myself, I was very young, were all syndicated. I was at a large fund, and every other one was syndicated with another big sandhill firm. And then everybody raised billion-dollar funds in 2000, and syndication suddenly went away. And Aspect is really around bringing syndication back, and we're really excited to say every single one of our deals, and half of them actually were referred to us by someone who wants to syndicate the Series A with us. So the whole idea of partnership and teamwork at the investor level, just like that's so important at the founder level, that's another thing. We look for great founding teams, not just great individual entrepreneurs. We've learned, Finn's smiling because we have a secret story about something that we worked with.
Can we hear the secret story?
That's really the key thing. Let's just say founder divorces are just as messy
we shared
as
it
others.
as a secret story.
Well, I did interview Eddie Liu, if he's here, the GOAT founder, and he talked about getting into a physical brawl with his co-founder. So I hope you don't run into too many of those. But you have talked about fixing the UX of venture capital. What do you see as being broken, and what's your solution?
Yes, I think the biggest thing that I learned moving from being an entrepreneur to being an investor is, as an entrepreneur, my experience with investors was that investors viewed themselves as very much on the sell side. Or the buy side. They were sitting back and saying, show me what you got. They showed up 5 minutes late to meetings. They weren't prepared. I would sit in a room, and the first question was, who are you? And the second question is, what are you doing? And it just didn't feel right as an entrepreneur. My view as an entrepreneur was they would be lucky to invest in my company. I'm trading equity for dollars, but also for the services and product and value add that Topher was just talking about. And so my view as an entrepreneur was that I was the one on the buy side evaluating them. And so as an investor, when I think about the user experience of venture capital, my customer is the entrepreneur, and my job is to please that customer. And I think the way you do that is you consider yourself to be on the sell side, right? And so I spend a lot of time when I'm talking with founders explaining how I think we could work together. My view is that you can compete as a venture capitalist. You can compete on 3 things. You can compete on speed of making a decision. You can compete on price, or you can compete on product. And I think when you can compete on product, you will end up with the best economic deals. And so I spend a lot of time trying to educate our customer as to the product that we offer and hope that they choose to buy it with their equity.
And how do you keep that fresh? I mean, you're looking at so many companies. To do that every single time, multiple meetings a day, that must be exhausting.
A little bit, but it's similar to interviewing, actually, right? You're sort of talking with people, you're trying to learn about them, my job in a meeting is to get to ground truth with a founder as quickly as possible, because there's lots of money out there, and most people that we talk with will be able to raise money. And as Topher was just talking about, in the last 4 years, I think 300 seed funds were birthed. So finding money is not the problem. It's sort of figuring out how to find the right money. And so if we can do our best to be transparent about the way we work, if we can be transparent about what we believe about the founder's company and their vision and what we like about it, where we see challenges, and figure out if this would be a strong working relationship, I think that's the majority of where we spend our time in initial meetings with founders, is looking for alignment of vision and an understanding of how we'll work together.
And Topher, you were mentioning earlier that the amount of money raised has been increasing. The valuations of these early stage companies, seed stage companies, have also been increasing. So are they overvalued? Is there a bubble in the seed early stage?
I don't think you can call it a bubble. While the amount of money raised and the valuations have crept up, the opportunity has also never been larger. When a company like, for example, Airbnb, they are a truly global company. Pinterest, a truly global company. Uber, these companies now are no longer limited to the US market only. Mobile has really driven global adoption of these platforms and products. And so, yes, the valuations have crept up. The amount of money raised has also crept up, but the opportunity has also never been larger. So it also further emphasizes investing in the winners. To Phin's earlier point, the 1 out of 100, that 1 out of 100 now is more important than ever because it truly has uncapped upside.
Theresia, Phin, would you guys agree or disagree with that in terms of the valuations?
No, you start with simple math. If you invest at one price, $5 million pre, and the company is worth 10 or 50 or $100 billion, that's an amazing outcome. But if you invested at $15 million pre, it's still an amazing outcome, but it's just math. It's 1/3 as amazing. It just is. And so I think that the prices have been driven up. They are at all-time highs. We've seen them rise basically 20% a year for the last 5 years. Wow. And now rounds are twice as big and valuations are 3 times as high as when I started in 2008.
Theresia, you were involved in Excel's investment in Facebook back in 2005, which was obviously very lucrative. And companies like Facebook have now grown into these mega giants, and there's been a lot of discussion about a kill zone around these companies, where if you're a startup doing something that is competitive or in the realm of what they're interested in, they'll just buy you or copy you. So do you think because of that, there's less opportunity for young companies to grow into these future mega giants?
Yeah, no, 2 things. So one, it's an interesting example, just agreeing with Phin and Topher. So we led the Series A in that round, which was perceived to be an extremely expensive round. And in fact, we went with 3 different term sheets. We knew what they wanted to match, which, knowing history, pretty sure that they wanted the $100 million valuation that Google got, because everybody knows that, and everyone wants to be just as good as the last great company. And our thinking was exactly the same. Look, Zuck's only going to sell 10% of the company. Whether we pay 6, 8, or 10 million for that 10%, we're just going to get 10%. Now, we never thought it was going to be worth 500 billion, but we were like, okay, the math is still good, is exactly what Phin said. On the kill zone thing, that's kind of been said every time there's a big company, right? So, back in when Netscape was getting out there, it was like, well, Microsoft is just going to crush you. And then, Google, and then it was everyone's going to get crushed by Google and sucked into the vortex. And what we've actually found is, as each one of these companies becomes true platforms, they create an ecosystem. And what that does is both creates opportunity for companies that build applications on top of those platforms, whether that's AWS in the case of Amazon, or Google Cloud, or early days building apps on Facebook, right, like Zynga did. So I think it creates opportunity, and then obviously those companies are always also big acquirers. So I think there's a kill zone if you try to go at their core business, but the great thing about it is it's classic innovator's dilemma. They have to focus on their core business, right? So if you take Google, for example, I was also an early investor in Trulia, was doing real estate search. Shortly after Google went public, it's like, you're going to get killed. Google's going to own everything. It's like, no, there's certain types of search that are completely antithetical to the one box, beautiful Google experience. So go after those things. And so I actually think that it's only a kill zone if you're going after their core business. You should go after things that seem to be too small for these huge companies, which turn out to be billion-dollar markets in their own.
That's a great point. And We were speaking earlier, you said First Round Capital saw 6,000 startups last year and invested in 27. I just want to drill in a little bit more on how you sort through all that noise.
I think there's probably half of it that is very easy to sort through. It's something, part of the benefit of focus on just seed stage is that we can look at something and someone comes in and they're raising $50 million. We know that that's not what we do. And so we also don't do international investing. And so there are a bunch of things that are just very easy filters right off the top. And so that takes out about half. And then of the 3,000, I think we're looking for certain trends. We're looking for founders that we've either worked with before, that we've heard of before. We also have a program called Dorm Room Fund, which is investing in college students. And so those people are rising up, and we're able to understand both the perspective of the kids that are rising up through college now and let that inform our broader investment strategy, but also specifically have access to that type of talent. So there's a bunch of different flags that we try to put onto things as they come in that help us filter. And then at the end of the day, it has to do with that resonance with the founder and understanding that they are educated about our product, they want to buy that product, and that we want to work with them, for the next 5 or 10 years to achieve their vision.
Mm-hmm. Theresia, I want to go back. This is the ins and outs of Silicon Valley, and you've had a lot of firsts in Silicon Valley. You were the first managing partner at Excel. You were one of the earlier co-founders of a venture firm. We've been documenting as journalists a lot of the underrepresentation and issues in terms of gender, sexism in Silicon Valley. Do you think anything has fundamentally changed as a result of that? And how do you actually rewrite the industry's playbook?
So I think that there's actually been a pretty significant change in the last couple of years. The short thing, so it first started out with sort of a bad reason that I'm sure a lot of you guys have read about in terms of some of the bad behavior by certain VCs and some funds that have dissolved because of it. And initially it was really sort of both entrepreneurs and our investors, LPs, would call and ask about things and want to know that this person was not going to create headline risk for me. No one wants to have that kind of bad press associated with their company or their fund. But the great thing is, I would say in the last 6 months, there's been a shift to the positive, and part of that's through stuff that I've been involved with, like All Raise and a lot of other great things, Time's Up, that's going down in LA, where people now see it as a positive. People understand that having diversity on your management team results in 21% improvement in your financial results, according to a bunch of public company studies. And the same thing is true, a lot of people think in terms of investments. You see different deal flow if you have different people. So, my firm is just focused on Series A, and we do certain sectors like cyber, future of work, digital health, and none of that's specifically about diversity, but we happen to be an investment firm that is half male, half female, 25% underrepresented minorities, and 50% first-generation immigrants. So our portfolio is 40% female when the industry average is 10%. So I think one of the positive things that can happen is just go out there, start showing that it's actually going to make a difference. And the biggest thing is founders, I think, get it. Everything is a race to get the best people on your team. So if you can create a more inclusive culture, it increases the possibility of who's going to come and join your team. So that's every CEO, I'm sure every CEO you talk to, their number one hardest thing is finding more awesome people to join my team. And it just makes business sense to be more attractive by being more inclusive.
And Topher, as a individual seed and angel investor, how do you make sure you're getting the diversity of opinions that you wouldn't have if you were at a firm with many other partners?
Yeah, that's one of the great things about being an angel firm now is the amount of collaboration. So we have, like I said before, we have an extensive network. So we work with almost every fund out there. Tons of angel funds are angels as well. And so we can get a very diverse group of opinions in a very short amount of time. We've always done a lot of diligence by asking close friends and partners of ours for their opinions. So that helps us get a different point of view than we would otherwise have, just internally.
And Phin, I think over the past year or so, there's been sort of a reckoning in Silicon Valley. Tech companies are now being blamed for all sorts of dark problems in society, whether that's tech addiction, harassment, spreading manipulation, propaganda. Do you think that has trickled down to the earliest stages of a company? Are entrepreneurs now thinking more critically about the future impact of the technology they're creating?
I think they are. I think there's a difference between the impact of the technology you're creating and then the culture that you're building at your company. I think those are both things that really matter. I think on the culture front, from corporate governance to diversity, we're definitely seeing that come up as a topic much earlier in companies' lives, which I think is a great thing. And this idea that as a founder, you're establishing the DNA of your business, you're establishing the way your company will operate going forward in your early hires, in your early decisions about culture, the way decisions are made, and the way you set up corporate governance, who you have on your board, et cetera. And I think people are thinking a lot more, to your question about how the Valley is changing, around adding diversity, and not just from a sort of diversity used to be tolerating different views, right? And I think it's one thing to say, you and I are different, and that's okay. And it's another thing to be inclusive and to say, you and I are different, and I want to learn about you because it makes me better, right? And I think that shift is starting to happen in the Valley from a culture perspective. From the impact of the technology, I think that people are, when we see them, they're so early. They're looking for initial product market fit. They're looking to have customers who want to use their product. And I think there's less thought about long term, if ultimately, this could be AI as a detriment, and sort of, is it creating jobs or is it destroying jobs? I think it's less of a concern for the early stage founders because they're just looking for something to work. And then as they grow, I think it becomes an increasing piece of their mind share.
And Theresia, you were able to see Facebook at an earlier stage and how it's evolved. Do you think the sort of difficult spotlight and scrutiny that Mark Zuckerberg has faced has changed the entrepreneurial mindset of some of these Series A entrepreneurs?
I agree with Phin. I think the Series A companies are not necessarily thinking about what's going to happen to them when they get large enough that they might get, regulation and scrutiny from that perspective. It's sort of like their dream that they could get that big, that they would be relevant.
But should they be thinking about that? Because I think the criticism is that, Zuckerberg wasn't thinking about that, and that's why all these problems happened.
So not to be I do think that the one thing that all companies are thinking about earlier is as they are collecting user information, they are much more relevant, even if they only have 1,000 or 10,000 users, about making sure that personally identifiable information is highly secure, and that they're being really clear with users about what they're doing with their data and not sharing that data without explicit user consent. So that is one change that has happened in the last few months I've seen.
Topher, have you seen anything along those lines that they've been speaking about, the data privacy aspect?
Not at the earliest stages, at least not at the seed stage. They're much more worried about their next day, their next user, their next product milestone, and raising their next round. And hopefully these become issues for them because they have such a vast user base. But at the stage we invest in, it's oftentimes pre-product or very early in the product's release, and so they're really not thinking about that. They're thinking about their next user and making sure they nail the use case.
And this panel is called The Ins and Outs of Silicon Valley, but we have a lot of iconic Valley investors looking abroad at other countries for the next big thing. Have you thought about potentially expanding outside of the US?
No, we've always focused on the US. For the last 10 years, we've focused on the US only, and for us, when we're investing at the seed stage, it's about understanding user behaviors, understanding the target market that a founder is going after, and not being in Asia or Europe, we don't fully understand the behaviors that drive product adoption there. So that's why we've really focused on the U.S. And focused even on the large markets here, because we really are also just a small team and with very limited resources. And so when you have that, you have to be very focused and pick your battles.
Mm-hmm. I want to talk a little bit about the velocity of deals and the speed at which money is raised, new startups are founded. What effect has that had?
Yeah, so I think we were talking about price earlier, and the thing that everybody points to when they think about price and price inflation is the supply of money. So there's way more money chasing the same number or slightly more investment opportunities, so therefore price goes up, sort of simple supply and demand. My partner, Bill Trenchard, made a great point, this is like 3 or 4 weeks ago, about it's not just the supply, but also the velocity and sort of the pace of those decisions and how quickly they're getting made, both in terms of the quality of that decision from an investment perspective and the entrepreneur's perspective. Do you really know the person that you're choosing to partner with? But also, the VC market or the capital market in general should serve as a check on entrepreneurial activity, right? It should serve as a way to say, this company, this idea, this market is a place that is going to have capital allocated to it, and this is not. And I think that check has basically gone away over the past 2 to 3 years as the velocity of capital has increased. People are making decisions where an entrepreneur who is either experienced or has an idea generally in a space but hasn't done the work to go through the idea maze and come up with the exact thing that they're going to be pursuing is able to access capital, $2, $3, $5 million, whereas that same amount of capital 3 or 4 years ago used to require a product built, users, and much more clarity around the long-term vision of the company. And so I think the biggest detriment to the velocity is that very, very talented entrepreneurs are pursuing ideas and locking in on ideas and raising capital behind ideas that are not worthy of their talent.
And Theresia gave me the fabulous idea of doing a really quick lightning round at the end. We only have a few minutes left, so you guys each get 1 minute to tell the audience one company or trend that you're the most excited about and one company or trend that you think is overhyped. And do not try to dodge the overhyped part, because that is critical for people to know. Who wants to start?
I'll go first because in fairness,
it was your idea.
So I think one trend that I'm super excited about is verticalized AI, or sort of application-specific AI. One trend that I think is most overhyped is generalized AI, or the stuff that you see in Iron Man. And one company that I'm most excited about is a company called Chime, which is a mobile-first bank that adds more bank accounts every month than the largest brick-and-mortar bank, and it's targeted towards gig economy workers and 20-somethings for their first bank accounts.
You want to go next?
Sure. One trend that we are very excited about is a lot of the changes going on in the content business. So we have a couple companies actually here today, one called Hooked, which is a platform for storytelling, and another company called Brat, which is a over-the-top TV network for Generation Z. And I think there's a real opportunity there to build these new products for the next generation to consume content, but also content that's tailored for them, specifically for them. And one that's overhyped, I could also say we're very excited about the trend, but also overhyped is just crypto and blockchain in general. There are a lot of, it's an amazing technology. It is, Web 3.0. There's a ton of potential there. But if you look at some of these ICOs and the amount of money going into that, specifically from retail investors, it is scary. That's a lot of money will be lost because a lot of these ICOs were just I don't want to say fraudulent, but they weren't.
That's
probably accurate. Yeah. 1 minute.
Yeah, sure. So I think one trend that's really interesting is I think finding new atomic units of communication, new experiences. As we were talking about, the established social media platforms make it very hard to compete around communication unless you can come up with a new way for people to actually engage. I think we saw that with the rise of Snapchat, and so I think looking at things in the AR market, maybe VR, I think that's earlier, but AR market that allow people to communicate in new ways and create new shared experiences. And we have a company called Ubiquity 6 that's working on some things in that space that's really interesting. And in terms of overhyped, I think we could talk about crypto. I agree. Talk about the scooters. I think that's interesting. But I think seed stage investing in general maybe is the sort of most overhyped right now.
Interesting. Well, I can say that the number of pitches I get about crypto, blockchain related startups and entrepreneurs has exponentially increased in my email inbox. So we are just about out of time, and I just want to say thank you to all of my amazing panelists and for everybody for attending.